What's up, everybody? It's Will B from the Blacksmith Podcast, and I'm glad to have you back for another one. So, this that you see on the screen here is a continuation from the Saturday morning Discord live. I will not be able to do that. I'm still active duty and I have important training for the next 6 weeks that I'm going to be doing. So I will not be able to do that Discord live tomorrow. However, I can finish the video in the breakdown of options today. So that is what we're going to do. Without further ado, let's hop into it. Now, this guy right here, this is Lawrence. This is Earn Your Leisure, but this guy in the video here, this is Lawrence, and he has his own channel, and he's breaking down what an option is. If you have not seen it, I will leave a link to the video, the first half, down below in the comments. Let's get it.
Someone trading short-term options without knowing technicals is like going to the Russian roulette table in Vegas. And
I don't know why he said Russian roulette. He doesn't mean Russian
Don't do
roulette.
it. Strictly
He
for
means
live, not for
roulette.
freshmen. That's not for freshmen. All right, let's keep rolling. Strike price. So again, strike price is the number, right? Is the price at which the asset can be bought or sold. It is the price that the given asset will appreciate, call, as if you're buying a call, or depreciate, that's a put. And so here's our example, right? Apple right now, again, it's at $175.85. If I'm going to say I want to see it appreciate, I come up with a price or a target number that I'm saying it's going to reach. And so $200 would be my strike. If I believe that Apple will pull back, I'm listening to all the reports, I'm following all my technicals and the fundamentals, and I'm saying, all right, well, I feel like there's going to be a pullback in Apple. Then I'm going to make a put, and so $150 would be my put. And so let's figure this out. This is pretty cool.
All right. So if you didn't understand what he's talking about, he's basically telling you that within options, there are two choices. You can either bet that the stock is going to go up, which AKA is called a call, or you can bet against the stock that it's going to go down, and that is AKA a put. That's what that is. Right. And I know why I didn't have this full screen before, because I had done this and I was showing you guys, I was showing you one of them and I forgot about that. Okay. So I'll show you right here. I'm going to walk you through doing one as he walks you through doing one. And okay. So trade hood options right here. And again, you do first have to pick an expiration date. I only do leaps, 2-year contracts, so they last a full 2 years. This one's going to go 861 days, so even better, because Robinhood is soaring. So I would not bet that in 2 years Robinhood's going to go down. I would bet it's going to go up, and it's at $115 right now. So my bet would be, could Robinhood reach 130 in 2 years? Yes. So you click this and it's telling you that one share is going to cost $40.30. But remember, options are allowing you to buy the right of 100 shares. So you got to move that decimal to the right twice. So this is going to cost me $4,030. See that right here? $4,030 for the full thing. All right. So that's how it works. And yeah, so let's keep going just so you guys can see.
Cool here. Right. So where are we going to get our strike price from? Now, past performance does not always predict future success. But if we're looking at Apple over the past 20 years, right? I know, like we always talk about, let's look at it since its inception, but let's look at Apple since its past 20 years. To your right, if you look at the performance and you look at that column,
there we go.
In parentheses,
better,
right? That is not a mistake. Apple has increased by 53,000% since 2001, right? And so if we're going to make a call, or that's pretty far out, let's not use 20 years. Let's maybe use 2 years, right? So in the past since 2 years, it's gone up 150%. This year, it's up 32% year to date. And so even a conservative number, because I know when Rashad calls me, he's going to want a conservative number. Could we say that Apple could appreciate 10% by 2024 each year, right? So that just means that Apple, which is 175 now, if it grows by 10%, it's at 192 by next December. If it grows by 10% in 2023, it's at $211, right? So that means that it grew at 10% each year, right? And that seems like that's something that's very viable to happen, right?
So what he's going over, he's looking at the chart. So maximum for Robinhood, they've gone up 202%. The past 5 years is going to be the same thing because they didn't IPO until 2021, which is right here, listed on July 29th, 2021. So they've only been in business for 4 years as a publicly traded company. The past year, yes, that is a percentage, 551%. Yes, that is a percentage. Robinhood has been off of the charts, and I've been enjoying every bit of it. As you can see, I have 506%. So I've almost got all of their 1 year percentage in my portfolio right here. Now, year to date, since January, they've gone up almost 200%. This stock can't be stopped. So what am I saying? I'm saying that's what he's showing you for Apple. He's saying if you look at a stock's chart like that and you see that they've been tracking well, now also you have to, I will warn you, I also have an option on it right here. I have a real option on it. I was supposed to do this on camera, but I ended up buying it anyway, so that you guys can see I'm not playing. I actually have an option on it too, and I actually have 305 shares. Not playing at all. This is 24% of my Robinhood portfolio. All right, so he's telling you to watch the trend of the company. If the trend of the company, the trajectory is good, great, fantastic, like or off the charts. This is out in orbit. 500% in a year, 200% year to date, and it's only August, and it's August, which the stock market starts going down in preparation for September, which is the worst month on record for the stock market. It can't be stopped. So you could safely bet that, and I shouldn't say bet like this is roulette in Vegas, but you could safely make a prediction that this stock is going to increase at least 10% in 2 years, at least 20% in 2 years, right? That's what he said.
Remember, our call was at 200. And so if we just said Apple 200 call for 2024 based on its past performance and a very conservative number of 10%, the likelihood of it hitting 200 is pretty high, right? So that's kind of one of those things when you look at strong companies and their past performance, now you see why you come up with these strikes.
Yep.
So if you want to, let's say Robinhood, right? Let's say it's at 115.04, right? And you want to know 20% increase, right? Multiplied times 0.2. So 23.08. Now you add that to 115.04, and 20% up from the price it's at now would be 138. So if you wanted to only bet that Robinhood or predict that Robinhood was going to increase 20% in the next 2 years, you could go 140. You could go 140 and see it gets cheaper as it goes up because it has less and less. There's less and less odds that it's going to, I'm talking like it's Vegas. There's less and less of a chance for it to hit that price in 2 years, the higher up you go. However, you could come down here and do what's called in the money calls, right? So in the money calls, this is a $30 strike price. It's already past this $30 strike price. So it's already at a 3.48%. But you would only have to pay the, I forget what they call it, but it's a fee for making the call. It's only $3 up. So it would only have to increase 3% to this, from this number to this number, and you're already in the money, is what that means. All right. But that's more of an advanced thing. Let's let them break stocks, the options down the basic way.
Warning, don't believe the AI trading hype until you watch this entire video.
Hi. Bye.
Yep. So when you're taking a look at options, purchasing contracts, not shares, it's important to understand the difference between the bid and the ask. So this is going to be a pivotal part of what we talk about here tonight.
This is the part.
So because this is what gets a lot of, I already saw in the chat here that someone said Robinhood order fills suck. So we're going to talk about the difference between the bid and the ask. So a lot of people, when they hop into options trading, they're immediately, as soon as they go ahead and enter a trade, they're going to give money to the market. And why is that? Because a lot of people are purchasing options at the ask price. So the ask price represents the minimum price that the seller is willing to take for that same security. The bid price represents the maximum price that the buyer is willing to pay for a share of the stock or another security. You never want to pay at the ask. And Troy's going to...
Right. So you get what he's saying? The bids right here is $37.85. The ask is $40.30. This is what they're asking for in order to sell you the right to buy those 100 shares. This is what the current bid is. This is what the least amount they'll accept, basically. Because you have to think, when you buy this for $37.85, they're getting $37.80. They're getting $3,785 for selling it. So if you were in order to understand how to buy it, understand being the seller. If you had these 100 shares, do you want to sell the right to buy your 100 shares for $37.85 a piece? So all in all, $3,785, or would you rather sell it for $4,030? If you can understand the seller, then you can understand the buying. So you as the buyer, you want to pay the least amount possible, but you as the seller, you want to get the most amount possible. That's what he's saying. So what could screw up your option is right away. If you are paying the ask, you are paying the most amount of money possible to purchase these shares, when you could have paid this or somewhere in between. Let's say you put 38. I think Robinhood, you have to do 25-cent increments. So let's say you put 38. Let's say you put 39. It's still not $40.30 a piece, because you got to multiply it by 100. So he's saying, and this goes for anything, folks. When you are purchasing assets, one of the most important things is the price you get in at. So when you're buying a stock, if you're buying Robinhood right now, you're messing up, because it's probably near its 52-week high. So you are it is probably at its 52-week high. So you're screwing up pretty bad. But if you waited until September and it pulled back to $90, there's a great price for you to buy in right there.
I'm going to show you, we have an example on the next slides where you're going to actually get a chance to see. So a lot of times you'll see like the bid will say 700 and the ask will say like 920. So that's called the spread. So when you hear when someone asks you, hey, what is the spread on that call that you're looking at or that put you're looking at? The spread is the difference between the bid and the ask. So if the bid is set,
so that's pretty easy, right? So, well, let him finish.
700, and then the ask is 920. That's a $220 difference in spread. So
all right, so you can see the spread here, right? Just do some easy math.
What's going to happen to someone that goes ahead and uses what is called a market order instead of a limit order. So when it comes to options, you want to use limit orders. Why do you want to use limit orders? Because you're able to go ahead and specify the price that you actually want to get into that security.
Hold on, you gotta tell them that again. The difference between market and limit.
Yeah. So market is just going to put you in at any price. So what's going to happen if you use a market order and there's a $220 spread? You're going to more than likely be down $100 instantaneously. So who wants to be down $100 instantaneously?
Not this guy.
I know all you guys don't want to. So make sure that you're using a limit order. So what is the best way to get filled with options is to use a limit order. Especially what happens is when you're actually buying out those further out options, the strategies that Troy and Rashad talk about, when you're talking about.
See what I just did here on the right-hand side? He said don't use a market order, so don't pay what the market is calling for. Put your price limit in there. So if you put in a bid for $38 and the price ends up soaring way higher, guess what? This probably won't get filled if the price ends up soaring way higher while you're putting this in here. Let's say it goes up to 117 or 116. This probably won't get filled, but you can still do it if you want it, because during the day it might fall back down, and in the day at 113, your order might get filled, right? But it's going to get filled at $38, right? So what you have to understand is you have to play this smart. Put in your limit and don't go any further than that. That's what he's saying.
2023 and 2024, the bid and the ask is going to be spread wide.
Why is Amazon paying me $63,000 a month? Well, I didn't make this kind of...
dude, I don't know. And I don't care. I'm doing a show.
Because there's not a lot of volume and open interest on the contracts, which we'll talk about later.
We're getting there.
So, yeah.
Yeah. And I tell people as simple as this, man. If you ever bought a car and you walked into the dealership and somebody tells you a price, 9 times out of 10, you're going to say, all right, well, I'm not paying that price. This is what I'm paying, right? And so it's the same thing when you think about these contracts. The ask price is the premium. The bid price is what you're going to pay. You're willing to pay that, right? And if you put it at a limit order, you're saying, I'm not going above that. Now, sometimes the limit will get filled and sometimes it doesn't. This is when we talk about patience, right? If it's not filled, that's fine. You can leave it out for a day. If it doesn't get filled, then do it again, right? You're going to stick to your script. That's your limit. You're not going above that. It'd be the same thing like if you're going to buy a car. This is how much I can afford. This is what I'm paying for it. I'm not paying anything over it. The problem is that a lot of people who are new to options come in and they click market, and sometimes it fills at the highest price as possible. In fact, it could say $920. By the time you buy it, somebody's already purchased it, and now it's going up to $940. And so you've actually paid more than you thought. And so that's why it's very, very important. This is like one of those keys that people will lose money right away, and they look at their...
I agree with both of them. And I'm telling you, the reason why you would lose money right away is because imagine this is the dealership, like he said, right? And add an extra 0 to this, right? And put a comma after the 7. Put a comma after the 0, add a 0 at the end. Imagine you go and you're buying a compact car, an economical car. Let's say you want a Jetta, 2025 Jetta GLI. It's a 2.0 turbo, and they're selling it for $40,000. Now you're paying way too much for that car. That Jetta should not be worth that much, but just get what I'm saying. Let's say an Audi TT. All right. Let's say an Audi TT, a brand new Audi TT. So this is the difference, right? Let's say the guy says, well, you know what? The car typically is $37,000, but you know what? For you, we've marked it up to $40,000. Would you buy the car? And see, most of you guys would be like, no, duh. But if they said, hey, that car is $40,000, we have not been able to sell it. We do not know why, but you're interested. So we're going to drop it down to $37,850 for you today. I can't make the deal any sweeter than that. Would you buy it then? Because let's say MSRP was $40,300. They just dropped it down to under MSRP. Yeah, you buy the car, right? And so that's the thing. Most people, they do options like they buy stock. When the stock is on the news and it's booming, they're like, oh my God, it went up 20% in a week. Most people, they are buying, click buy, click buy. Oh my God, it's soaring, it's soaring. And then what happens is the stock, you never researched why the company was soaring or why the stock of the company was soaring, what news came out, what happened, what month it is, because there are months that are great for the stock market. There are months that are terrible for the stock market. You have no idea why it's soaring. And then when, let's say it's July, and July is pound for pound the best month for the stock market. Let's say now August hits, you bought on July 28th, so you had a couple days left. Now it starts dropping in August. And guess what? You bought at the high. So let's say it drops down 30% by September. You're giving money to the market right away because you didn't know you were buying at the peak, and down you go. And people buy options the same way. So just be smart on how you buy.
Account like how come every time I buy my option contract, I'm in the negative? This is probably one of the main reasons why that is happening. So treat it like the dealership. Look at the bid, maybe go 10 to 15 cents or above the bid and say, that is where I'm staying. I'm not going above it. If it fills, it fills. If it
That's
doesn't,
what I do.
it doesn't.
That's what I do.
Let's get into some things.
All right. Here's something else. Understand, folks. Options is not for beginners. Options are not for beginners. I know I said that grammatically incorrect the first time, but listen to me. Options are not for beginners. I know they will tell you the bulk of their money, and I don't remember what percentage, but at least like 80% of their money is tied up into long buy or long hold stocks. I would dare say probably 80% of my portfolio is in long-term stocks. 305 shares of Robinhood, 145 of Nvidia. This isn't the most impressive stock portfolio either. Don't think but for 1 minute this is the most impressive stock portfolio. I'm just getting started. This is just Robinhood portfolio. 28 shares of Palantir, 700 shares of SoundHound AI, hyper concentrate into stocks, right? Microsoft, they gave me for free. I didn't buy anymore. I saw value because I want growth in my portfolio. Microsoft, all of its booming growth has been had already. But you see, Robinhood is still doing it. Nvidia is still doing it. Palantir still doing it. SoundHound AI is still doing it. This is quantum computing. I've got, I shouldn't have done that. I was trying to actually see how many shares. 150. But you see what I'm saying? Most of my money is going to be tied up in the actual shares. Now I'm here for bullish for IPO. I did get into Figma. Misty is but you get what I'm saying. I only have a couple contracts. These contracts right here for SoundHound are 50-cent calls. They're not expensive at all. So 7 contracts here. It's up 31% because I bought them at a great time, right? QBTS, it's a $1 call. Look at my calls. They're all inexpensive. Robinhood's 105, right? So I bought an in the money call for Robinhood. But most of my money is tied up in long hold stocks. They're not tied up in options. And the reason, one of the most dangerous things for you guys getting into the market is if you have a gambler's mentality. If you have a gambler's mentality, you're going to lose. You're trying to play this like it's Vegas. Put it all on red. See what I did there? Put it all on red, and you're gonna lose it because this is not Vegas. If you have a gambler's mentality, you need to go to Gamblers Anonymous and get that out of you before you start investing. This is not gambling, this is investing. So you need to start long term. And then we'll walk you into options. But let's keep watching. A couple more minutes.
Yep. So now we have here, this is TD Ameritrade for those that are new and may have not looked at TD Ameritrade. TD Ameritrade Thinkorswim is one of the most reputable platforms out there for people to trade. TD Ameritrade Thinkorswim is set up like this. This is actually showing you how to actually go ahead and actually execute and buy an actual options contract. So here we have up here, option strategy will start in the top left corner, single order. The underlying symbol obviously is Apple. Also, what you want to know is when you're actually buying options, this is key, action, that action button right there. Whenever you're purchasing options, calls, or puts, it always needs to be on buy to open. That's whether you're on Charles Schwab, Fidelity, E-Trade, whatever platform that you're on, it needs to be on buy to open when you're purchasing options. Now, when you are selling,
an important day is coming for every American with money in the markets, and it'll be here sooner than
the day you skip
when you are ready to close your position, it needs to be on sell to close. So you need to make sure that you have it on buy to open and sell to close. If you end up having it in something else, you're going to mess yourself up. So it needs to be buy to open when you're purchasing your options, and then it needs to be sell to close when you're selling your options. Then you have next door, which you're going ahead and typing in how many contracts you're purchasing, either 1, 2, etc. Then you have select your expiration. You have that expiration, so you can select the date. And we have the dates pulled up over here, and we'll get to those in a second. Your strike and is it a call or a put? And we'll get to that. Then also you see limit order. So this
I have it filled in for you.
Yeah, limit order. You need a limit order. And then guess what? Price. You see what happens is when you have a market order, that price box right here won't pull up. Because all you do when you hit market is you just hit review order. Limit order, then you put in price. Also time in force, day. So you want to keep it on day. If you keep it on day, it'll make sure that it enforces during the day. Now, if that price is at a limit order and it does not enforce at the end of the business day at 4 p.m. Eastern Standard Time, that order will cancel.
Right.
Yes, it will.
And that's not a bad thing, y'all. That's not a bad thing.
Yeah.
All right, let's stop it right there. We're coming to the end of this video, guys. I hope you learned something out of this video. We didn't get too far into it, but there's a lot to break down. This is stock options for beginners. That doesn't mean it's going to be easy. Beginners does not mean it's necessarily easy. I understand. But if you know nothing about investing, if you know nothing about financial literacy, you need to be taking notes. But I hope you found this helpful. Guys, leave a comment, hit a like for the algorithm, show some love. The Blacksmith Podcast out. See you in the next one.